This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
So today, we're going to take a look at Amazon and the mounting pressure it still faces from antitrust regulators.
Plus, with the Hollywood strikes raging on, we check in on Netflix. Will the stall in production impact the streaming giant's cash flow?
Woohoo! But first, Gucci parent company Kering has plans to overhaul after the brand disappointed in the first half of the year, which is so funny because luxury was supposed to be super hot. Bringing us some of the proposed changes as well as the details is Bloomberg Intelligence senior luxury goods, beauty, and home care analyst Deborah Aitken. Deborah, I thought this was like the golden year for luxury stocks. Was that just like a blip, like a China hope phenomenon in the first half of the year?
I think China is doing its thing. The idea from management was very much January, February that it would take a little bit of time for everything to open up, not only from a travel perspective, but certainly in store too. And that is playing out. We are getting now double-digit growth out of China from a low base last year, and that should add speed and momentum through the rest of the year. But I think it's also been at a time when maybe the US for the aspirational brands has paired off a little bit. And so we've seen that China maybe isn't the 30-40% growth that some had anticipated.
Well, just here in New York, Deb, I can report that the European tourists are back, have been back for a while now, and I'm assuming they're contributing to the high-end luxury shops here in New York. I cannot say the same about Chinese visitors. So what are the companies telling you? What are the brands telling you about China just in terms of, maybe some of their tourism or lack thereof and the impact on their brands?
For China, we have double-digit travel retail growth within the mainland. So there's a huge amount of domestic travel. And then also there's very much double-digit growth into Hong Kong, Macau, and also Japan, taking advantage of that weekend. So that's what we're hearing from the Chinese side. We're expecting in the second half that there will be more international flights coming through, both to the US and Europe. And as for that very bullish US consumer at the very high end, they are also making trips to Europe. So where you have some Europeans into the US, there are still hordes of US into Europe too.
I'm not one of those people. What do you mean? I didn't shop in France for 2 weeks. But focusing on Kering in particular, they're also doing some kind of overhaul, some of their brands maybe struggling. What brands are doing well and which ones are struggling that we need to kind of focus on the revamp?
It's all about, for Kering, it's all about the Gucci brand. So it's half of sales, in some points, 3/4 of profitability. And for the last couple of years, it just feels like it's lost its way. And they've been pushing through a transition to elevate its luxury status. So to pull away a little bit from the fashion orientation and where they've had so many collaborations with fashionistas, and more to push it towards the higher end in terms of quality and the equity value of the brand. And so in this particular half year, as that's where we started, we were looking at the numbers for actually Kering was 3% growth for this half, and it was only 1% coming through from Gucci against a very easy 4% comp. Whereas if I give you a couple of other numbers, I know the quarter in Q2 was led by Hermes, which was up 28% against a big comp. Moncler, 26% against a big comp. And there was some negativity also around LVMH, 17%, because the market was really questioning whether LVMH had stalled in the US, but that was against a huge comp. And so we're seeing everything else generally doing well, and just that the management overall really needs to redefine what Gucci's about. It isn't going to be a quick fix. And as you said at the beginning, we have a ex-global CEO of Chanel coming into the board, and an internal overhaul with Francesca Bellatini, who's very strong. One of the brands of Kering is Yves Saint Laurent, doing very, very well. She and the CFO, Jean-Marc Duplay, will move up to new deputy CEO roles at Kering. And with Palus taken over as CEO at Gucci in the interim, with Marco Bizzarri to exit soon.
I know all about Gucci. I read the book. I saw the movie. I'm all up on my Gucci. Now, Kering also took a 30% stake in Valentino, another world-class brand. Tell us about that transaction.
They did. I think that's going to do ever so well for them. So, in effect, they're paying 1.7 billion euros for a 30% stake, and they have the option to take full ownership by 2028. It was a decent multiple in this industry. It seems Hyper 16 times EBITDA is a decent multiple because basically we've seen this industry get 25% bigger in 2023 by the end of 23, even versus 2019. And that's considering 2 years of disruption, store closures. So you expect going forward high single-digit growth forecast across the whole of this area, and even stronger for the very high end. And Valentino has such good qualities, and also particularly at the very high end with couture. But what Valentino does really well is it offers product, because if we think of Valentino as a two-step with two different Valentino brands, so it offers aspirational entry price doing well, and extremely high end above the $20,000 type price tag doing very well too. So there's a lot to be learned. And in the meantime, also Kering has taken on board, for example, an acquisition of Creed. So it's brought eyewear inside. It's taken on the whole Kering Beauté, bringing beauty inside and creating its beauty division. And that will absolutely, for Creed, push up that division too over the next few years.
Hey, Deborah, we really appreciate it. Thank you so very much, Deborah Aitken. She is Bloomberg Intelligence Senior Luxury Goods, Beauty, and Home Care Analyst.
Let's turn now to President Biden's 2024 budget, where a new spinoff proposal could hamstring deals worth tens of billions of dollars. For more on this, we're joined by Bloomberg Intelligence government analyst Andrew Silverman. I like a good spinoff as much as the next person. What's President Biden's budget? How does it view the spinoff business?
That's right. So President Biden, I think, in this proposal, views spinoffs, generally speaking, as something negative, that he's suspicious of spinoffs, right? Are companies using the spinoff to sell business segments without tax? Are companies using the spinoff to relieve themselves of debt without tax? Those are sorts of the considerations that the IRS is worried about and the administration is worried about in this proposal.
Well, break that down for me. I actually don't know this. If I am a business and I want to spin something off, what are my tax benefits? Like, how good would it be for me to do it that way?
So you can spin off a business segment and also push off a fair amount of your liabilities to the entity that you're pushing off. You can do an IPO of the entity that's being spun off and take all of the cash from the IPO and send it back to the parent company. You can take the liabilities of the parent company and push them off into the subsidiary being spun off and have those liabilities assigned to that company. And IPOs in spinoffs like the Kenvue transaction, Johnson & Johnson and Kenvue, you have essentially $18.3 billion that this entity is going to have to pay for its assets in order to spin off from Johnson & Johnson.
Spinoffs like M&A, spinoffs, this is a big business. I mean, I'm looking at your research. 2013 to 2022, U.S. companies engaged in 409 spinoffs worth a total of $858 billion. I mean, this is big business. What's the other side of this argument here? What are the lobbyists for the private equity firms and the investment bank? What are they saying?
Well, spinoffs are good for everyone, right? I mean, shareholders get a segment of the company that is able to sort of open up to value that's been sort of subsumed in the conglomerate before. The companies have a method of being able to pay some of their liabilities through the spinoff, and they're putting this entity that's sort of underutilized out there for shareholders. And I would argue that the government also has a benefit in the sense that now this entity is going to be publicly offered and have to file with the SEC, and so they get more clarity, sunshine into their financials.
So is this just like a political thing? So he can say that he's going after corporations or something for the 2024 election? Or does this have teeth?
Well, so I think it definitely has teeth. You look at Kenvue spinoff, for example, that I mentioned before. I calculated that in that transaction, Johnson & Johnson, if this were in place, it might have to pay as much as $2 billion of tax.
Oh, wow.
Due to the spinoff, because what the administration is concerned about is contingent liabilities, things that had been taken into consideration before. Accounts receivable can count as an asset, but accounts payable that had been counted before now would be counted.
The Republicans in Congress, I can't imagine they're going to let this thing go through. I mean, because this is just talk about. You could really make the argument this is just anti-business and anti-corporation, and I can't imagine Republicans allowing that to go through.
Right. So, with the House in Republican hands, it's very unlikely that this gets adopted, but it doesn't mean that this isn't a real proposal. A lot of the things in the president's budget proposals end up becoming things that Congress adopts later on. And originally, this was a congressional proposal. It originated in the Build Back Better bill. So this is something the president actually took on and expanded on. And I would also argue that this is really Treasury's view on spinoffs now, right? They're basically saying that what we're concerned about is that these companies aren't going to be economically viable after the spinoff occurs.
Oh, I see. So they just basically use it to get the money back to the parent company, and then the company left is nothing.
Yeah, but I think the spinoffs have generally, for every disaster out there like that, I mean, there's a million of these things. I mean, again, as your research showed, I mean, tons of these transactions worth billions of dollars, and arguably that's, beneficial for shareholders overall. So we'll have to see how that goes. Our thanks to Bloomberg Intelligence government analyst Andrew Silverman.
Coming up on the program, could Manic stocks see a late summer slowdown? You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Stocks rallied and participation grew in July. BI's Market Pulse Index hit Manic territory for the first time since January, but could the fever pitch and activity lead to a slowdown in gains? For more, let's bring in Bloomberg Intelligence Chief Director of Equity Strategy, Gina Martin-Adams. All right, Gina, first, you got to tell us what Manic territory is.
Yeah, good question. So we developed a market pulse index to derive an expectation of sentiment within the equity market. It gives us an idea of when stocks are completely oversold, as in panic is the predominant emotion within the equity market, and when stocks might be a little bit overbought, and aka mania has started to develop. And what the index does is sort of toggles back and forth. Most of the time it sits at neutral, and as a matter of fact, from February through June of this year, the index was in a neutral state, which suggests, status quo. Investors are not too overly cautious, nor are they too overly optimistic, as indicated by market internals themselves. But in July of this year, we detected a little bit of overconfidence or mania developing. And the signals that we use are things like breadth within the equity market, volatility within the equity market, the performance of defensive relative to cyclical sectors and the like. And the composite of 6 different indicators there would suggest that as of the end of July, we were maybe a little bit too overconfident, maybe a little bit too manic in terms of our equity positioning, and due for a bit of a consolidation.
Well, to that point, typically when that indicator hits manic, what happens after that?
Yeah, so manic is an indicator that ultimately results in a slowdown. It's as though when you're at panic, the market is set to put the pedal to the metal and gains really accelerate. And then by the time you hit mania or a manic reading on the index, gains really slow down tremendously. And that's what we've seen so far in August. The index has hit something of a stall state, really around the 4,500 level for the S&P 500. We've sort of lost a lot of momentum, as is consistent with periods of time after the manic reading. Now, interestingly, I think most people want us to say, oh, mania means you got to sell stocks, panic means you got to buy stocks. It doesn't work quite that evenly. Most of the time, you consider history, stocks do tend to rise. So mania really just means a slowdown. Take the foot off the gas. You probably see a little bit of performance rotation inside the market toward more quality type of assets, more defensive type of strategies, and away from sort of the pedal to the metal cyclical exposure that you would get out of an indication of panic.
So, I mean, to me, it just feels like a lot of this market, not all of it, but a lot of the market performance year to date has been really narrow with the Magnificent Seven stocks, the big tech names. If I believe that, do I then go look for some of the stuff that has not participated, maybe some value names?
Well, so it's been interesting because most of the market actually has participated. You've got more than 70% of stocks in the S&P 500 trading above their 200-day moving average as of the end of July. The biggest of the big stocks have driven most of the gains, but largely because they are the largest and they've had the strongest gains. But you are seeing participation in the rest of the market. It's just not that the rest of the market is leading. You do tend to see, after such concentration in market leadership, a broadening of the trade, and this has been something we've really been talking about since May, where you got to sort of peak concentration levels. Those typically indicate either you're going to see some pullback in those concentrated gains or a broadening of the trade, and our view has been that broadening is the most likely outcome because we're starting to see some earnings improvement outside of those top stocks. If you flash back to the beginning of this year, really the vast majority of the earnings improvement that we've seen in the index has come out of those top five stocks. But with the second quarter earnings season, we started to detect some improvement in the outlook emerging for the rest of the index as well. And that should generally drive a bit of broadening performance, maybe a little bit less concentration in equity market gains, just in the biggest of the big.
So where does it go to then? Some cyclicals have started to play ball, particularly in July. Like, where do you need to be adding then, and where do you need to be taking back?
You know, our sector scorecard has generally pointed to cyclical sectors for most of 2023, really starting in December of last year. The scorecard relative ranked financials, industrials, some of these classic, very economically exposed segments of the market highly, and that's been the case throughout the last couple of quarters as well, while technology and communication stocks, which contain some of those biggest names, are at the top of the sector scorecard. The combination of price momentum and breadth, as well as relative value, earnings trends, and revisions, also point to emerging performance potential for some of the other cyclicals like financials and industrials, where investors really haven't paid a ton of attention. I think intriguingly, when you look at the dynamic of financials in particular, you see the yield curve as becoming increasingly inverted for most of this year. Over the last month, you've started to see some yield curve steepening develop. If that continues, that would generally support better performance for financials. And with respect to industrials, even though everyone's talked about technology and communication stocks as really leading gains, industrials actually broke out to new highs over the course of the last month. So certainly some broadening opportunities emerging in the rest of cyclical sectors as well.
Hey, Gina, I know reading your research that this second quarter marks, I believe, the third quarter in a row of negative earnings. Is that the trough? Are we going to trend up to positive earnings in the back half of the year?
Yeah, I think it's really important at this point in time, Paul, to look at earnings with and without the energy sector. Recall, energy is a laggard in the cycle. It does tend to move after the rest of the S&P 500, and we saw last year energy producing tremendous gains while the rest of the index produced earnings declines net. That was very important for driving price and certainly driving broader sentiment to the equity market. What we're seeing this year is quite the opposite. In fact, in the second quarter, for the first time in more than a year, we saw ex-energy earnings flat to slightly positive for the S&P 500, or at least that's how we're tracking so far. So we are already seeing ex-energy earnings trends improve. Now, the energy sector, unfortunately, faces really difficult comparisons for second and third quarter of this year that will likely keep broad index earnings underwater. But matters, frankly, more for performance because the energy sector is a cost input for the rest of the index and also a small share of market cap for the S&P 500. What will matter more for performance is what happens with those ex-energy industries and sectors in the S&P, and analysts are forecasting the worst of the worst to have passed with the first quarter and sequential improvement to continue through the rest of this year.
Before I let you go, if you're looking at Manic for the U.S., what is your signal telling you for Europe?
We don't have a signal for Europe, unfortunately.
That's fair enough. That's fair enough.
This is a market pulse index that we developed really specifically for the U.S.
But I feel like that actually says a lot.
Yes. Can I still look at the relative strength index? I just learned that function, RSI, and that feels pretty good to me. Is that still something that is a good indicator, looking at RSI?
Yeah. Oh, absolutely. We use a 14-day RSI as well as a moving average convergence-divergence indicator as two of our core indicators of technical conditions in the equity market. We just published on this again as of the end of July, and what we use RSI for is really a confirmation or non-confirmations with price trends. What you saw from RSI is consistent confirmation of an uptrending market all the way through June. But then we lost a bit of momentum in July, and RSI did not confirm the July gains in stocks. So it did also, in consistency with the Market Pulse Index, line up in favor of a bit of a slowdown coming for stocks in the late summer months.
All right, Gina, thank you so much for joining us. Always appreciate getting some of your insight. That's Gina Martin-Adams, Bloomberg Intelligence Chief Director of Equity Strategy.
All right, coming up on the program, Amazon under growing pressure from the FTC antitrust enforcers. Could a lawsuit be on the horizon? We're going to break that down next.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
Okay, so there are reports out there that the FTC antitrust enforcers are going to get ready to sue Amazon, and it could happen as soon as this month. It could also go on for years. Joining us now with more is Jen Rees. She is Bloomberg Intelligence Senior Litigation Analyst. Okay, so will it happen, and what will it look like?
Well, both of what you just said are true. It will happen, and it probably will happen this month, and it will also go on for years.
Excellent. Ding, ding, ding.
So there you go, because that's how long these things take. I mean, if a complaint is filed this month, which looks very likely.
What is the complaint? Well, what might the complaint be?
So the complaint will be generally over monopolization. And, it's been widely anticipated because Lina Khan was named the chair of the FTC under the Biden administration. But before she was in that role, she made it very clear that she basically felt that Amazon was a big, bad monopolist that was engaging in all sorts of anti-competitive activities that were harmful to competition and harmful to rival sellers and consumers and workers. So people have been waiting for her to bring this lawsuit, and we know that an investigation of Amazon started actually before her tenure during the Trump administration. So it's kind of about time. It's been a couple years. And we think the suit is probably going to focus mostly on Amazon's conduct in its online marketplace. Not its cloud businesses or some of its other businesses, but mostly how it treats third-party sellers on its marketplace, whether it uses their data to preference itself and to harm them, whether it gives itself preferential treatment in search results, whether it enters into agreements with third-party sellers that prevent them from lowering their prices on other websites outside of Amazon, and whether bundling its products through Amazon Prime and entrenches its monopoly.
The stock is up about 65% year to date, so the market doesn't seem to be too concerned at the moment. What does Amazon say in its defense?
Well, look, almost all of this conduct absolutely, I think, is supportable by what I call pro-competitive legitimate business justifications. There are justifications for, let's say, price parity clauses. It can prevent free riding. It can protect Amazon. It can actually bring prices down. The bundling of Prime adds to efficiencies. It's good for consumers. Fast shipping and all of the innovations that came along with it. So what we learned from kind of our monopoly lawsuit Bible, which is the Microsoft suit back in the 1990s, is that where business conduct that maybe causes some harm to rivals or harm in the market is supported by legitimate business justifications that are pro-competitive, usually it's found to be lawful.
Because I can't imagine too many consumers saying, I've got a problem with Amazon's retail business, and we love it. We get tons of stuff and we get it like overnight.
Cheaper and like it works for me, so what's the problem?
Right, exactly. And that's the conundrum here, and that might be why it took so long to bring the suit, because how do you craft a theory of harm, where most consumers really don't view Amazon as the enemy. And most consumers actually think it's brought innovations and convenience to the market, and that's going to be very difficult because that'll be the basis of its defense in this lawsuit.
So I guess to that point, how does Amazon either fight against it, or what might they be asked to give up or do?
Well, look, I think we have a great roadmap here, to be honest, because the same accusations have been levied against Amazon in the UK and the EU, and Amazon has settled both. It has settled the EU formally, and in the UK, it's on its way to settling. It looks like it will. And it's settled with just behavioral concessions. We will treat third-party sellers in a neutral, non-discriminatory manner. We will allow for 2 different buy boxes, so to speak. A buy box is, what comes up on the website that makes it easier for a consumer to click on and buy a product. And sellers want that buy box because they get bought more. Their products get bought more often. We won't use sellers' data to develop our own Amazon Basics products. I mean, it was just a lot of promises. And the EU and the UK, both jurisdictions have basically said, this is sufficient to fix our concerns. This will fix the problem. And I think the same could be true in the US. And I think Amazon would be willing to make those commitments, but we just don't have a Federal Trade Commission that's interested in settling matters in that way.
Why is that? Is that due to the administration that happens
I'm
to be
laughing
in
because I'm like,
office?
isn't this politics?
Yeah, is this just politics, or is this the way regulatory environments, the FTC's always been in this country?
No, it's a little bit of both. It's not the way the FTC's always been. As a matter of fact, the current chair thinks the past FTC has been way too conciliatory, way too easy on monopolists and on companies that are engaging in M&A. It's just that this FTC and this chair believes that there needs to be an effort to broaden out antitrust laws, that enforcement's been too lax. We need to do something more. We need to expand these laws and catch more conduct and stop more mergers. And she has the backing of the administration. So she's moving forward with that.
If they made these changes, how much money do they lose by making these seemingly not big a deal changes?
Well, I haven't done that kind of a calculation, but I'll tell you, most companies that are readily willing to enter into a settlement and
probably
agree,
means it's not that bad for them.
Probably means it's not that bad. Because if it was really going to be that bad, they wouldn't have agreed to these things and they wouldn't have offered them up in the EU and the UK. And honestly, think about it. Think about Amazon just from your perspective as a consumer. How much will it really hurt them to add another buy box or not to push their own products up to the top of a list when people know those products are out there and they're going to be looking for the best price and the highest ratings.
Oh, fair enough.
Is a breakup of Amazon's retail business? I'm not even sure how you would even do it, but is that even in the cards somehow?
You mean like from
I don't know.
AWS? Like what?
I don't know. I'm just wondering because I'm thinking about what do they want?
Yeah, that's exactly what they want. I mean, they are seeking a breakup. I think in their mind, what they'd prefer to see is breaking up operating the online marketplace from selling your own products. So separating out the Amazon Basics and Amazon's own products from the marketplace. I don't think it'll happen. I don't see a judge ruling for something like that. I mean, we have learned that, again, from the Microsoft precedent, that the remedy is supposed to be the least intrusive and least drastic to fix the problem. And we see that the remedies are deemed to fix the problem in the UK and EU, and those are not structural.
Right. They're not actually trying to then kill the company.
Exactly.
They're just trying to fix the problem. Okay, great stuff. Jen, I really appreciate it. Truly the smartest person that we have to talk litigation that I've ever spoken to. Bloomberg Intelligence senior litigation analyst Jen Rhee, thank you so much. While most streaming platforms struggle to turn a profit, Netflix seems like an exception. Estimates show it's expected to generate almost $7 billion in EBITDA this year. But then going forward, we have the Hollywood strikes, and that might impact its outlook. Well, Geetha Ranganathan is Bloomberg Intelligence senior media analyst. Just set the stage for where Netflix is, and then we'll use that as a jumping off point for where it will go for the back half.
Oh, absolutely. So when Netflix reported its 2Q results, they did have explosive streaming subscriber growth, and this is something that, everybody was kind of hoping for. But when it came to the other metric, which was the revenue growth number, it kind of underwhelmed a little bit. And so there are different factors there that are at play, but the one big number, and this is a number that the street is really focused on, is profitability and free cash flow. and they more than outperformed by raising guidance for free cash flow from $3.5 billion for this year to over $5 billion. And that is a function of many different things. So obviously there is a whole content cost rationalization that is happening across the industry. But for Netflix in particular, they're also being helped not just by the subscriber growth in the top line, but also a little bit by the Hollywood strikes.
You know, Tom Keene always says, Paul, when is the streaming business going to be profitable? And I say, well, Netflix already is. Talk to us about kind of the free cash flow. And I was looking at your report. You've got a model that shows that you think maybe free cash flow can be better than where the street is forecasting.
Yeah, so, we kind of just modeled out free cash flow. Paul, as you may well remember, this was a company that used to be criticized for cash burn. So, just as recent as 2019, this company was burning about $3.5 billion in cash. And a lot of that was because they were really pivoting away from licensed content into originals, creating more and more of their own content, whether, it's something like Stranger Things or The Witcher or, Squid Game. All of these things, require money, and they were investing heavily in that. But all of those heavy investments are now kind of bearing fruit. And so we're expecting them actually to outperform even on their guidance this year. They've already guided to about $5 billion. 2024, however, will be a little lumpy, but then we'll really kind of start to see this stable, consistent free cash flow generation coming through from, 2025. We're actually projecting over $8 billion. That's about 9 to 10% ahead of what consensus has at the moment.
Wait, you said that Netflix will be helped by the Hollywood strikes. Did I hear you right?
Yes, temporarily. And it's not just Netflix. Actually, everybody's being helped. Ironically.
Wait, I thought it was going to be the opposite.
Yeah, so what it does is it actually boosts the financials. Because they're spending less money, so it really kind of helps their bottom line. And it kind of comes at an interesting time, Alix, because everybody is so hyper-focused on, the profitability of the streaming business and whether these companies are going to be free cash flow positive and whether they're going to be, generating consistent earnings. And so this almost kind of helps that argument a little bit. But of course, if this kind of spills over, if the strikes spill over into 2024, then it really becomes a problem because, you don't have, your content pipeline is drying up. And there's really no differentiator because at the end of the day, content is the lifeblood of all these companies.
All right, so if you're Netflix and you're going to start throwing off a bunch of free cash flow, what do you do with it?
Yeah, so there are a couple of different things. So obviously the question that was asked to them is, there are so many assets right now that could potentially be of interest, especially as you kind of look out, building new verticals, whether it's in gaming, whether it's in unscripted, and they've always kind of taken this very conservative stance, right? They are more a build versus buy kind of an approach, and that's exactly what Ted Sarandos said on the call as well. So, yes, they are kind of venturing into these new areas, whether it's gaming, but it's a very, very kind of measured, very disciplined approach that they're taking. So yes, they've bought a few studios, but again, I don't think we're necessarily going to see them do anything super flashy. Things could, of course, change because the one area that Netflix hasn't yet ventured into, but could potentially get into is sports, especially if they're really taking the advertising business seriously. So remember, they just made a foray into advertising just a few months ago. Not yet a material business, but they have said publicly that they do expect advertising in the U.S. itself to be a bigger business than Hulu. And Hulu really right now is kind of the gold standard when it comes to advertising in the streaming industry. They generate over $3.5 billion. So they do expect to ramp up. And if you do want to make, advertising on a digital platform, I think, sports kind of lends itself perfectly because you have a captive live audience. We're seeing all of the tech giants kind of experiment with this, whether it's Amazon with Thursday Night Football, whether it's, Apple with MLS. So they could potentially be a player in that field. And then you need gobs of money. So that's when the cash flow comes in handy.
So then they hold on to it until they make that decision. So net, if I read between your lines here, will I get quicker episodes of Love is Blind? Like, will seasons come more quickly now because of the Hollywood writer's strike and their need to preserve cash, or what?
So that's an interesting question. So I think, obviously the writer's strike affects only scripted content. So yes, they are going to double down when it comes to unscripted. The one advantage that Netflix has versus its peers is they also have a good amount of production capacity and a lot of content that comes from overseas territories. So, if you think of, the Squid Game and the phenomenon that it became, you have about 25, 30 shows right now, Korean TV shows that they're kind of working on or European language TV shows. So they do have that advantage. But yes, to your point on unscripted, yes, I do think they're going to definitely double down on that.
Has anyone seen Love is Blind except for me?
I have.
Oh my God. It's so awful, but you can't stop watching it and it your whole life becomes Love is Blind.
Oh,
Anywho,
boy.
go ahead,
I'll
Paul.
steer
Say
clear of
something
that.
smart.
Yeah. Hey, Geetha, what's the feeling in Hollywood with this strike? Because this could get both sides seem like they are entrenched here.
Yeah, this is going to be, kind of a tough slog, I think. And it's, as far as past strikes are concerned, they've never really kind of dragged out beyond the 3-month mark. So it's going to be interesting to see what exactly happens here. It's a very, very difficult time, I think, in Hollywood for both sides. So obviously the content companies have to, preserve their profitability. This has really come into question now, how they kind of become profitable, especially for their streaming businesses. So they are looking at all possible ways to control costs. But then you have so many of these other different, sticking points, whether it's the use of AI, we've seen kind of all of these news articles talk about, companies wanting to kind of leverage AI in their content creation process. And I'm not necessarily sure how well that's going to sit with some of the artistic community and with the writers and the actors alike.
All right. Great stuff. Geetha, super appreciated. Always wonderful to chat with you. Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.